Hey, everybody, welcome back to another episode of Raising the Flipping Bar. I'm your host, Derek Marlin, and today we are going to be talking about something that's kind of near and dear to our heart, and we're roughly halfway through 2024. So I thought it was a perfect time to kind of reflect on the market. As you guys know, I'm definitely a data nerd myself, and so a new article just came out by the John Burns Research and Consulting Company, and it definitely caught my eye, and it really dives into the world of investor-owned real estate. Welcome to Raising the Flipping Bar, the go-to podcast for aspiring and seasoned real estate investors. I'm your host, Derek Marlin, and I'm the CEO of Elevation. We're a real estate investment company based right here in Denver, Colorado. We'll dive into smart investment strategies, market insights, and essential tips for scaling your real estate ventures. Whether you're making your first investment or your 100th investment, this podcast is your blueprint for success in the ever-evolving world of real estate investing. Get ready to elevate your real estate game and begin your journey with me. So let's get going with today's episode. Okay, kind of want to set the story. And for me, this is all about the blending of, honestly, my family upbringing and my background in three different inflection points in my life. We're going to be talking about institutional investing and what larger investors are doing and how we classify exactly what they're doing, and then how you can take that and run with it to hopefully help either understand the market better or even develop your business in a better manner. And so I'm originally from New Jersey. Most people say, they're like, dude, you don't have an accent. Well, I've moved back and forth between New Jersey and Denver 3 different times while growing up. I lived in Dallas. I went to undergrad at Montana State University in Bozeman. I went to graduate school at the University of Florida, and then I ended up back in Denver. So long story short, I don't really have an accent unless I get really pissed off and my inner Jersey does come out from time to time. But I grew up in a Wall Street family. The reason that that's important, we'll really dive into here in just a couple of minutes, but I was there in the 80s and my whole family were more on the fixed income side. So to put that into perspective, fixed income is the debt or the bond side of the market versus stocks are the equity side of the market. Interestingly enough, the stock market almost gets more attention, more play between the New York Stock Exchange and NASDAQ, as far as the states go, as the 2 biggest exchanges. But the bond market is just as large, actually. There's just as much debt out there, whether it's corporate debt, whether it's government debt, whether it's institutional debt, than there is in the stock market. I really remember back being a kid in the 80s, driving into New York City. I'm one of 4 boys. It's kind of funny because it's graduation week that we're recording this, and we've got tons of family flying into town, which is really fun. And I just remember being a little kid, having to dress up in a sport coat and a tie, and God bless my mom. There were 4 boys. We were all within 7 years of one another, and I'm the oldest. And she's parading us around New York City. We were going in to visit my dad, and a stranger comes up to us. We were almost to my dad's office in a huge skyscraper in Manhattan. And he says, hey, do you want to see something you've probably have never seen or never seen the rest of your life before? And now being a parent, I probably need to give my mom a hard time. I'm like, are you insane? We just talked to some stranger in the middle of New York City, and he's going to take you and your 4 little kids in sport coats looking like nerds and probably, rob you blind and take you and drop you in the middle of nowhere, Tony Soprano style. But luckily, he took us on the floor of the New York Stock Exchange. And I don't know how or what this guy saw, or he was just trying to be nice, but I remember, like, it literally gives me goosebumps. At that point, I'm in 4th grade, and he walks us into the floor of the exchange. And this is coming from somebody who's been in AFC Championship Denver Bronco games with crazy stadiums. I've been in the swamp with the Florida Gators with over 100,000 people. And the New York Stock Exchange is so loud. It's insane. I remember all of us just immediately like putting our hands on our ears. It was the coolest thing. It's something that I'll definitely never forget. So I have roots kind of in the Wall Street side of things. For me, it was also what kind of drew me further into what we're talking about today, doing a business with my father, which is really cool. He was a 35-year veteran and a very seasoned bond trader for over 35 years. He owned and bought and sold a couple of different companies and stakes in companies. For us, when I was getting out of the corporate world, is from 2012 to 2014, we started our own boutique brokerage company. And that was awesome. So the great thing about that is getting into the Wall Street side of things, if you will. From 2012 to 2014, we owned a boutique trading company that, again, focused primarily on fixed income. For me, it was a huge benefit because I got so much more education and knowledge than I would have ever had I gone in directly into real estate investing. So I studied and was able to pass and obtain my Series 7 license, my Series 63 license, And then I was almost ready to actually take the Series 65, which is the Registered Investment Advisory license. But that's another part of the story that we'll get to here in a second. Ended up not getting that because we got out of the bond business. But it taught me a ton about institutional quality investors, how to work with those folks, super hard work ethic. Like I said, my dad's a Wall Street guy from the 80s, so I learned to swear at a very young age, very proficiently. I was able to have a thick skin and I think thrive in that industry. But it also taught us a lot about risk and risk mitigation and risk reward. And so when we were in the bond business, my dad did a lot of trading throughout his entire career in the high yield space. What that is high yield is essentially code for high risk. So obviously there's that seesaw and teeter-totter of risk versus reward. The higher the risk, the more reward you should get, meaning the higher return on investment or interest rate that you should get. So we had a position, meaning we owned bonds that were high yield bonds, which meant high risk, high reward. And so we were buying those bonds at hopefully a lower price, marking them up a little bit, and then reselling them, and we would make the spread. Well, when you're talking about million bond blocks and millions of bonds being bought and sold at one time, you don't need a huge profit margin because you're dealing with a lot of volume. Well, we own these Puerto Rico bonds that were backed by the pension fund for Puerto Rican federal employees, and the values just tanked. We sat on them for a while. The market never recovered it. And sometimes you have to rip the Band-Aid off. Another thing that I'll never forget is a loss of $287,000 in one day. And that was because we had bought the bonds. The market moved away from us. We tried everything we could to sell them to other people. And the only way that somebody was willing to buy them was at a significant discount of what we had paid for them. And so we lost a shitload of money, obviously, in one day. But what that taught me is sometimes you have to rip the Band-Aid off. You have to get capital back in your pocket to then redeploy and do it in a more efficient manner. Obviously, that 100% translates to real estate. So I wanted to give you guys some context of kind of my background, the way that I grew up, and the way that we frame our real estate investing mind. And so to kind of tie it into this article of what we're talking about today with this amazing piece of research from the John Burns Institute, I want to kind of fast forward to our experience over the last 3 years as a company in Elevation, how we've succeeded and worked with institutional investors. And then more importantly, how can you use this going forward? Because investors definitely help move the market, but it's not quite the clickbait, the headlines where everybody says, oh, these damn investors and damn Wall Street, everything's going to hell in a handbasket. I've always known that it's not the case because we're in the business, but we're going to give you some really great stats for you to essentially look at this and go, oh, interesting, makes sense, and hopefully helps your business. So how this translates to you is I want to talk a little bit about our experience in the institutional world over the last 3 years. And we've got a phenomenal client that we started working with back in 2021. We primarily work with them on the acquisition side. And so the term you're going to want to look at, and we'll have it in the show notes, is the SFR space, which stands for single family rental. These are larger institutions or larger companies and investors that are buying rental properties. They're holding them either infinitely, or a lot of them were holding them for a 5 to 10 year period. We work with them on the acquisition side. And so we were primarily doing on-market acquisitions for this hedge fund in the Metro Denver market. This client of ours really was in about 20 other markets across the country. So it was really fun to get to know fellow brokers, fellow investors, and how we can best service this client. But it's funny, people talk about, well, how the hell did you guys do that much business? We were essentially writing on average 30 offers per day, and we were just cranking them out because we knew the exact metrics of the style of house they wanted, the rent that we could generate with our help of buying those properties properly. They would rehab them. They called it rental bulletproof. So they did all the work up front and then had these great rentals. It's also was really fun. And that's what brought my wife, Ann, into the business too. So she got her license, and we had 2 other employees that were working with us at Elevation at the time. And I'm really excited to kind of say, or proud to say, is we were the #1 team per capita or per volume at Your Castle Real Estate in all of 2021 and all of 2022. So in about an 18-month time period, we helped this hedge fund and institution acquire 285 plus homes in and around Metro Denver. Again, it really helped us cut our teeth. I think it was like things happen for a reason, that you grew up a certain fashion as a kid, you get away from it for 15 years and do different things. And then I get back into finance. I'm 100% guaranteed that's one of the ways that we won this client account. And we're working with other institutions in the future. It's not only a passion of mine, but it's kind of a skill set that I have that I think not a lot of other investors and certainly most real estate agents don't have this skill set. And so what we love is that, again, that was 2021 and that was 2022. And it helped us create a system so we can properly help clients in the future. It's good and it's bad in that we're proud that we help them acquire the right properties at the right price points, and they actually haven't sold any of them off. I think some folks that bought some stuff in 2022 really overpaid and bought when the market was way too hot and way overbid, and they're now selling some of those properties off. So again, wanted to kind of give you guys that context of like, okay, where did we come from? What were we doing with Elevation as a company? And then that's going to translate into this article. So the title of the article, and obviously it'll be in the show notes, is Charting a 22-Year Roller Coaster of Investor Activity. And so we're going to walk through this article, but what I want to do is really give context and help put some guidelines and some classifications together of how do we define what size an investor might be. And so I'm going to go from the, I'm using air quotes, the quote unquote smallest investor all the way up to the largest size of investor. We're going to kind of help segment these out to help properly, in my opinion, just understand this article better, and then you to use this information to help grow your business. So the first classification is, I'm kind of almost taking my spin on it and then a bunch of other articles. So this isn't word for word in the John Burns article. But to me, the entry-level investor is what people call mom and pop investors. That is the vast majority of people that actually own rental properties or investment properties in the United States. And that's why this headline's like Wall Street's buying all of Main Street. Mom and pop owners are people that have between 1 and 9 investment properties. That's a lot. Don't get me wrong. If somebody owns 9 properties, they are probably in the top 5% of wealthy individuals in their market. But that's not huge when it comes to, in comparison to other institutions. But interestingly enough, that is by far the largest bucket of people. When people say, oh, those damn investors are buying all those houses, it's actually people buying a rental property, or it's somebody house hacking, moving into their first property, having a life event, having a kiddo, getting married, whatever you're going to do, you move to a bigger house and you keep that one as a rental. Well, you're now in this bucket. That makes up 18% of all investment properties across the country. So just let that sink in. Everybody's all pissed off about institutions. That's America, and that's how people are building tons of wealth. It's what we did when we first got started as well. So that's 18% of the market. We then go up the food chain and we talk about professional investors. And those are people that own between 10 and 99 properties. That's a little bit larger quantity of homes, but it only makes up 6% of the market. So those are people that are probably doing it full time. They are small syndications, they're investment groups. It's that next step above mom and pop investor. And then we start to get into what I think most people would perceive as, again, quote unquote, Wall Street. So the large or the private equity style of investors those are people that own between 100 properties and 999 properties. But the interesting thing about that is it drops off a cliff as far as how many of that is the number of homes across the country. It's less than 1%. So yes, big number of one person or one private equity fund owning that many homes. You own 700 homes. That's a crap load of houses, but that's less than 1% of the market. Then you jump to what are called institutional investors. Those are the folks that we deal with and have dealt with in the past. Those are people and primarily companies, I should say, that own over 1,000 properties. Again, that's less than 1% of the total market. Those are the headlines. That's the clickbait. That's where all this is coming from. When people and also people on Capitol Hill, there's some legislation out there that's being floated around saying that institutions couldn't buy properties or there's be this monstrous incremental tax on things. It's less than 1% of the market. The last classification or the last bucket, and this is definitely in the article that we'll get to, is what's known as iBuyers. iBuyers own 1% of properties, but that's also at any given point because typically an institutional holder is a person who's going to buy that, keep it as a rental. An iBuyer, so think what Zillow used to do, what Open Door kind of does. There's a handful of other smaller iBuyers in various markets across the country, but they're essentially doing what we're doing, just in my opinion, not on as efficient of a manner. They're flipping properties. They're buying it. They're giving people cash offers. Behind the scenes, typically, significant fees are still getting charged. So that's a whole nother podcast and a whole nother debate. But they're normally fixing them up and they're selling them. But at any given point, they own about 1% of the market. So again, if you think about it, you're looking at 23% of all investment properties are owned by people that are mom and pops or people that are professional investors. Barely 3% of the market are the quote unquote big guys. So again, I want to kind of put that in context. And I think that's huge when it comes to, well, what does Wall Street own versus what is just a person who's working hard and has a professional job and has acquired a handful of rentals over time. That's the majority of who we're talking to. And those are people that, hey, again, that's me. That's when I first started. Those are the people that we want to support. So let's walk through what are called the 7 phases and the evolution of this investor activity. And then we're going to hit on some key points because I think this is super interesting. So we're going to take a quick break and tell you about the Next Elevation Academy. If you're looking to dive deep into real estate investing, this is definitely the event for you. Our academy features over a 100-step process to help you navigate every single thing from market analysis all the way down to every aspect of project management. So this is tailored for both beginners and seasoned investors. And our one-day intensive training will equip you with the strategies and insights needed to elevate your real estate investing game. Spots are definitely limited, so click on the link below in the show notes to sign up and transform your approach to real estate investment. Okay, let's get back to the episode. Not only as a backdrop of why the housing market is somewhat acting the way that it's acting, but more importantly, how do you use this data to best fit your company and your strategy to help you succeed and win in the future? So in working through this article, it's something that wasn't in there, but it's something that I've always thought and then did a little bit of homework and research on the back end. We'll put this in the show notes as well. But a lot of it was from why did we get into these different quote unquote housing crashes and where did the real estate market evolve from? I think the big piece of the puzzle are 2 different administrations from a government perspective. So we had the Clinton administration, Bill Clinton, our president from 93 to 2001. For being a Democrat, he was still fairly pro-business and he was definitely pro-home ownership. And then you get into George W. Bush, obviously Republican, hyper pro-ownership for people. And obviously President Bush was from 01 to 09. We do know that a big piece of that puzzle was people became homeowners that absolutely should not have been homeowners. They were not financially qualified. That's definitely a part of where the quote unquote crash came from. I'm always thinking back to personal points in my life to help resonate with what we're talking about from a content perspective. For us, it's dating back to 2002. We bought our first house and my wife, Ann, had just gotten her job with a small business getting into the wedding planning industry. I did have a good corporate job on paper. It almost makes me sad to think about this, and I'm going to give my old boss, Rick, a little help. But I came out of graduate school with an MBA and my base salary was $28,000. So yes, I made commissions, but we did not qualify for a lot of house at that time. I'll keep the bank nameless because I don't think that's very nice, but there was a regional bank out there that the banker was honestly pushing us to buy a house or to quote unquote qualify for something that was $200,000 over our real budget. So we were supposedly qualified to buy something that was $400,000 in 2002, and we could barely make the numbers work from our experience in personal finance. We bought our first house at $203,000. Like, just let that sink in. That's a big reason why there was a problem. Another thing that I would really highly recommend is read the book or watch the movie The Big Short. That talks about the housing crash, and it really helps give you context of why a lot of this happened. And obviously, a lot of it's hindsight, but a phenomenal movie. I think an even better book by Michael Lewis. So definitely watch that. But kind of wanted to use those as backdrop and context for this article. And so if we're scrolling through the article, it breaks it up into 7 different periods of investor activity that dates back to roughly the last 22 years. And the first one is called the easy credit period. And that was from essentially 2002 is when that started. And I really look at that. It really kind of ran through about 2006 leading up to the housing crash. That's exactly what I just described. There was so much credit out there. Everybody was getting approved. You know, in The Big Short, it actually goes and talks about people buying houses in Las Vegas and people that were in the professional dancing occupation. People own 6 different houses. that probably shouldn't have happened. So that easy credit area from 2002 to like 2006 was kind of that first bucket. That's when we qualified for something that we absolutely should not have qualified for. And where that led into the next classification is essentially the foreclosure boom. That one was obviously super tragic. It was terrible. It was from starting to kind of tip in 2006 and 7, and things got really bad in 2008, 9, and slowly started to bottom out. In 2000, I guess luckily, that's when we started buying rentals. That's when we got in the space, and I was nervous because people were like, why are you trying to catch a falling knife? But we knew that when things cash flowed, that was going to be a huge way to build wealth over time for our family. And so we were kind of in the market at that time. I do think that something that's underplayed is the reason why the market didn't drop even worse than it did and truly make it an Armageddon or another Great Depression was Wall Street started saying, wait a minute, we can buy some of these houses. And people started buying in bulk and kind of stop the bleeding, if you will. I think that's the next kind of bucket of time that I think is important to take a look at. That's from 2007 to 2013. There were tons of foreclosures. Looking at from a metrics perspective, I should have probably framed this earlier. Starting back to 2002, it says that rental investors owned 9% of all homes in America and were roughly 12% of all the transactions. So that's in 2002. To kind of bookend that, even though we're jumping ahead and put that in a context of where we're at right now, is it's around 23%. But it's all 5 of those buckets of folks put together that I just described earlier in the podcast. So if we go to that foreclosure boom really started in 2007, we were out of that in 2012 and 2013. And again, it says investor transactions were about 24% of all the buying and selling going on. But again, that's mom and pop all the way up to big investor, the institutional type of person. The next bucket, which again, I know people are kind of thinking I'm nerding out too much. Looking at these graphs, which we'll have in the show notes, it's crazy to see where all this volume comes from and where these purchases come from. But the next bucket in classification is from 2014 to 2020. And they're calling that the iBuyer boom, starting and the foreclosures ending. So interestingly enough, at that point, investors started to tail off a little bit. So it says that investors fell to 18% of the transactions in 2020. So we were starting at 12, we peaked up at about 24%, and then things started to kind of tail off a little bit, even though the iBuyers were ramping up. And again, think of that as just big time flippers, people that were doing it more in a cosmetic fashion and buying and selling and really not holding from a rental perspective. That leads into the 6th classification or the 6th bucket in time. And that's being called the low interest rate home price boom. Really, that should also be called COVID. So from 2020 through 2022, that number ticked up significantly. So investors owned on average 26% of the market, and that's the highest it's ever been in our country's history as of the end of 2022. To me, there's a big reason for that. I'm kind of jumping back to my notes because yield, which is a fancy way of saying what's your return on investment, the yield on those properties was significantly higher. And because interest rates were still so low, the treasury market or owning government debt was way lower. So there was this big spread. And that's when investors realized, yeah, we can make a lot more money. So again, people started buying rental properties earlier on. Ironically, this is when the mom and pop investors really started to sell some of their properties. So from 2020 to 2020, rental yields far outpaced treasury yields. And then that started a new sector too called the build to rent. That's where construction and new construction was being pieces of new neighborhoods were being siphoned off and sold to investors to own as fancy and nice rentals because they were brand new properties, which you kind of can beat up administration, but I think that's a great evolution that we've made, that not everybody should be a homeowner and people still should have nice housing to live in. That really helped fill that void and that gap, is that build to rent. That's still, I think, going to be a strong sector of the market here for the next 10 years. That was kind of that low interest rate 6th bucket of time. So the last bucket is really where we are right now, and they classify it as the rising rates period of time, and that's 2022 to 2024. It does say that investor activity remained relatively consistent with between 23 and 25% of the market. Investor and owner occupant activity declined because of rising interest rates. large institutional groups began selling more homes than they were buying, and small rental investors also were selling a lot more than they are buying. So that first bucket that we talked about, the mom and pop investor and the professional investor, that actually dropped down to 9.9%. They're starting to sell. And it makes perfect sense because you're trying to find a good return on investment. It's hard to get it in other places. You've owned your property from a rental perspective for, let's say, 10 years. That is a monster appreciation in the value of your property and the equity you gain. It's really smart to take some chips off the table. It's kind of a funny, cheesy thing. So whenever I go to Las Vegas, I do love to play cards. If I'm sitting at a blackjack table, I always wear the shirt with the dad pocket. That's the pocket that old school, we think of our parents that maybe put their pen in, or, if you're a teacher, maybe you had your little calculator in there or whatever. I will take chips and I will literally just put them in my pocket. Even when there's swings playing cards at the table, you can always walk away and be like, oh, I've actually got this nice chunk of change. So it's just like, as they say, take some chips off the table. And I think that's exactly what's going on right now. As we come to the tail end of this episode, I want to try to tie this all back together. For us, I'm going to go crystal ball. We'll look back at this and I could be obviously insanely wrong, hopefully a little bit right, but I want to put it in a context of like, okay, what the hell does this mean and where are we going? We are now also, we have been over the last 3 months working with a different institutional client, and we're doing exactly what the John Burns article said. We are helping this client look at their portfolio and say, okay, in this area, your rents are probably topping out. You've owned this home for 7 years. You're going to start to have that deferred maintenance. The furnace is going to go. The roof's going to go. You're going to have to infuse a bunch of capital in this. You've got this big spread in equity. You should sell this property. Versus another one, we might look at it when they only bought it 3 years ago. Rents still have a great way to go in a good area, and they can really essentially they should keep those properties. Our team has sold over 30 properties for this one institution in the last 75 days. And so we can really attest and talk to what's going on now in the market. Things are not being dumped. They're being strategically allocated. I think personally, they're smart. They're building up their cash war chest for when rates come down back into a historical normal perspective to redeploy that, hopefully in Denver. And that's something that we're building our relationship with the folks at EXP and being able to have nationwide coverage. But to me, it's all about having those rock solid systems to be able to service those clients. It's also really building relationships with other agents. So when we did tons of acquisitions, I believe our 285 homes equated to us getting relationships with around 200 new agents so we can develop business there. Now we're selling these properties and we're properly educating how are we representing our client, the institution, properly. But are we making it a win-win for the people on the buy side now? I think that's super, super important. So the way we look at it is we kind of took the fire hose of that crazy institutional business, formulated a plan, developed a staff. We've got rock solid systems. And now we've taken that fire hose and we feel like we can fight any fire. So again, where I go with this is, okay, we talked about 7 phases. Where does this go in phase maybe 8 through 10? I am obviously not smart enough to talk about probably more than that. Disclaimer, crystal ball, who the hell knows where this goes? Consult your lawyer, consult your tax professional, consult people that are smarter than me. But again, take it for what it is. But to me, I look at big macroeconomic data. And I really want to look at very smart analysts to help formulate our opinions. So looking at the Ivy Zellmans of the world, the Meredith Whitneys of the world, obviously big people like the Warren Buffetts of the world, like trying to figure out what they're doing so that we can kind of tail on data that they already have that I probably don't have. And then we really want to be in the trenches, which again, we've helped people on the acquisition side. We're helping institutions on the disposition side. We also work with individual investors that are trying to build their own portfolios as well. So it's really our bread and butter and where we're looking at this. We get Wall Street data, we get real-time active data of transactions, and then that helps me at the very end tip my decision-making with my gut and my gut feeling. So that's where this comes from. So again, it's not about hopefully necessarily looking back and saying, well, was I quote unquote right or was I wrong? But it's making the best possible decisions with the information that I've got now and being forward thinking and properly aligning ourselves with the right people to work with, both on our team, specifically with Elevation Team or just other agents that we're working with other institutions, and really just building a better machine or a better mousetrap. That's exactly what we're doing. So here's my top 6 takeaways for where I think things are going. Hopefully this last 30 minutes has kind of given context to it. No newsflash here, but I think it's sadly higher for longer. meaning our interest rates are going to stay higher. All we ever hear is that they think they're going to cut rates and they kick the can down the road a little bit longer. Inflation isn't quite where it needs to be, especially core inflation as it relates to housing, energy costs, and rental property costs. I think getting to a historic sweet spot of 5.5% to 6% for an interest rate would actually be the best case scenario of a new balanced market. It would still lean a little towards sellers because the biggest thing is number three, there's a big continued shortage in the supply of housing, definitely in Colorado and even nationwide. Depending upon what data you look at and what stats, we have a housing deficit of anywhere on the, I think, the ultra conservative end of about 1 to 1.5 million homes. I've seen other pieces of research that says that we're 3.5, 4 million homes short of what we need. I think there's a lot of undetectable immigration going on in the country that those folks need houses too. And so I think that number is actually higher, or I should say on the higher end of that spectrum. So I think that shortage is going to be a key piece of the puzzle. My fourth data point, I do think the Fed will probably cut rates at the end of the year, and they'll gradually cut in 2025. They do not need to quickly unravel and kind of have a double dip. And so I think they're going to be very cautious. Again, I'm not here to debate politics, but obviously the election being in November is going to be a key defining point of what's going on with rates. Those are supposed to be totally independent, but I don't think that they are. So I think there's going to be some easing up, which will be great from a debt perspective, but that's a catch-22. I think when those rates go down, people have been used to seeing mortgage quotes in the 7s or even the 8s 6 months ago. So if you can get something in the low 6s or see something with a 5 handle, you're probably going to move because you've been putting off life occurrences and events, and you've now got 2 more kids and grandma and grandpa are living with you. People are kind of bursting at the seams in certain properties. You're going to have to sell. So that is going to create tons of competition. So a little bit of pick your poison, kind of a pro tip. If you're thinking about doing a move, the next 3 or 4 months, I think, are going to be the best time that you could do that because there's going to be a ton of competition at the end of the year and leading into next spring and summer sales season. I think it's going to be super competitive. Again, it's only those 3%, but it's still a lot of volume of those institutional and large investors and iBuyers. They're going to be chasing yield, and they're going to have money that's been built up. I know from my days at Wall Street, if you're not deploying that capital or putting that money to work, investors are going to take it back and they're going to invest it somewhere else. I don't necessarily agree with it. Sometimes people buy deals just to buy a deal and place capital, but I think that's going to help the supply and demand. I shouldn't say help, but that's going to create a continued imbalance. So those are kind of the 6 things that we're looking at. The reason why Wall Street is looking at that is they've got the 4 quadrants that real estate provides, and that's appreciation of the asset, depreciation from a tax perspective, principal repayment. So essentially somebody else is paying down your debt. And then there is typically, hopefully, there's actual cash flow. If you take that quadrant, that's why people invest in properties, especially from Wall Street. So kind of as we wrap up the key takeaways, again, there's pros and cons, I think, depending upon how you're affected with larger institutional buyers being in the market. But I really wanted to classify that of ballpark the quarter of the houses that are owned by people that aren't owner occupants, 3% are the big guys, and 22% are people that own between 1 and 99 properties, which again, I'm a huge proponent of. I think that's a good thing. Do your research. Don't fall for the headlines. I think that's another huge takeaway. We should all do that in life, but even when it comes to real estate investing, that is the case. And then be creative problem solvers. For us, that's how we kind of won this institutional business. That's how we're growing elevation in the Colorado market and hopefully other markets in the future. But I think that's a really big thing is, again, being a creative problem solver, both for your large clients and your more individual clients. Would love to connect with you guys, engage with you guys. Reach out to us, tell me I'm full of shit and I have no idea what I'm talking about. That's great. I want to always engage the dialogue. But thanks for tuning in, and we'll catch you guys on the flip side. Thanks for tuning in to this week's episode of Raising the Flipping Bar. If you found value in our insights and stories, let's keep the conversation going. Connect with me on social media and be sure to share this episode with friends or colleagues who might benefit. Your feedback and reviews help us grow and reach more listeners like you. So please, if you enjoyed this episode, leave us a review. Thanks again to the Elevation Academy for sponsoring today's show. If you're interested in learning more, click the link in the show notes below. And remember, every property tells a story, every deal brings a lesson. Keep reaching for those goals, and we'll catch you on the flip side. Hey, everybody. Thank you so much for listening and watching Raising the Flipping Bar. Just a basic overall disclaimer is that A, this is not legal advice. B, this is not tax advice. C, this is not financial advice. I hope you get the gist, but I'm obviously not a lawyer, not a CPA. Hell, I'm not even a real estate agent, actually. But in general, we hope you get a ton of value out of this, but there is a bit of a disclaimer. Please consult a professional if you have any questions whatsoever. Thanks for tuning in.